I'm going to go ahead and call this meeting to order. This is a meeting of the Finance Investment Committee of the Vallecitos Water District for Wednesday, October 30th, 2024 at 4 p.m. at the district office. Do we have any public comment?
No, sir.
No public online?
No, I think all of our participants are done checking. No.
Okay, we'll dive right into it. Item number 1, FY 2024 audit results.
Wes, you want to kick it off?
I'll kick it off. Good afternoon, everybody. So this year, the audit actually started in June. I think we had an audit kickoff meeting for the Finance Committee. Auditors came and did the interim work during that time, and actually then came in September to do the field work. So there's a difference between the two, and I won't explain it because I'll let Coley do that. But we've now finished the field work. We're working on drafting financials to be brought to the board in December. So Coley's going to give an update on the status of the audit and the results of his procedures.
Great.
Coley, would you like to share, or do you want us to roll it over here? I think you're muted.
So sure.
Okay.
All right, so can you guys see the screen?
Yes.
Yes.
All right, cool. So yeah, as Wes mentioned, my name is Coley Delaney. I'm a partner with Boone Group, and I'm the engagement partner on the district's 2024 fiscal audit. I'm just going to go over kind of the scope of work. If we have to talk about audit responsibilities under the generally accepted auditing standards, so I'll cover that. Just a quick overview on like our approach to the audit, and then we'll just go over the audit status and results. So pretty easy on the scope of work. We're basically just auditing the financial statements. There's no federal grant audits or agreed upon procedures or anything like that included in the scope of work. So with that audit of the financial statements, so that we actually audit the basic financial statements, and the district issues an annual comprehensive financial report. So the basic financial statement is basically a sort of a piece of the ACFR. So the ACFR will take the basic financial statements and it will add an introductory section, which includes like a transmittal letter, the organization chart, that sort of stuff. And then it will also include a statistical section. So those are both considered other information and are outside of the basic financial statement. So the basic financial statement, again, so that has the financial section is the piece that we look at, but it does include MD&A, which is unaudited, but we do have responsibilities to read and review that document and make sure that the numbers tie and that the analysis makes sense. So, but we do not provide assurance on that. But then the statement of net position, AKA balance sheet, right? Income statement of cash flows, and footnotes. Those are all audited. We do have required supplementary information for GASB, which is going to be disclosures and 10-year schedules. Working on 10-year schedules. A couple of the pension schedules have 10 years in them this year. I think for like the first time that they both have 10 years in them. But so pension and OPEB schedules are in the what we call RSI. Again, that is unaudited, but it still basically feeds in from other pieces that were audited in the financial statements. And then I mentioned what we call that other information, which is the stuff that is included to make your financial statement a full ACFR, which is that introductory section and statistical section. And again, in those pieces, we do not provide an opinion on those. However, we still do kind of a decent amount of work on those to make sure that they do tie to the financial statements and make sense. So within that, so the audit reports that we're going to issue, we have the first one is the independent auditor's report on the financial statements. That's our, that's what everybody thinks of. That's the audit opinion letter, and we will be issuing an unmodified opinion on that, which quote unquote equals a clean opinion. We also do, since this is a government auditing standards audit, We also issue what's called the Independent Auditor's Report on internal control over financial reporting and compliance and other matters based on an audit of financial statements performed in accordance with government auditing standards. So we'll refer to that as the GAGAS report, which is generally accepted government auditing standards, or sometimes it'll be referred to as the Yellow Book report. And there again, we are going to be issuing an unmodified opinion. So that's the best opinion you can get. So both of those reports will have clean opinion. All right, so I mentioned we were going to talk about some responsibilities as I'm required to kind of disclose this stuff and communicate this stuff with you. We'll start with management. Management is responsible for these financial statements, and I will say management has been very good about taking ownership of these statements. I think as far as a spectrum of my clients, I have some that are just like, I don't know, that's your report, you you do it. Your team really takes ownership over it, and it's I prefer it that way. It's a better way to go about putting the financial statements together, to have the team that has ownership and buy-in into those financial statements. So that's good. Management is responsible for presenting the financial statements in accordance with US GAAP, adopting the accounting policies, and hopefully adopting sound accounting policies. They're responsible for establishing and maintaining internal controls over financial reporting, and then providing the auditors with evidence to support the amounts and disclosures in the financial statements. And ultimately, they are responsible for to make sure that those financial statements are fairly presented in all material respects. And management is responsible for preventing and detecting fraud. On the audit side, our responsibilities are to basically, to give you an opinion about whether those financial statements are materially fairly stated in accordance with US GAAP. We are required to plan and perform the audit to obtain reasonable but not absolute assurance on that. So we do have materiality in play. We're required to consider internal control over financial reporting, but we do that only for the purpose of determining our audit procedures, and we don't provide an assurance or any assurance or an opinion on the district's internal control. We're required to exercise professional judgment and maintain professional skepticism to identify and assess the risk of material misstatement in the financial statement, whether due to fraud or error, and design our procedures in response to those. We do obtain an understanding of internal control relevant to the audit in order to do our risk assessment and design our audit procedures. But again, we do not provide an opinion on the internal control. And we do evaluate the appropriateness of the accounting policies used and the consistency of the accounting policies used year over year as well. And then we're also required to conclude whether or not there are conditions out there that would affect the district's ability to continue as a going concern, which obviously we did not have any issues with. So for our approach to audit, we break that up into 4 phases. Phase 1, detailed planning. Phase 2 is what Wes referred to as our interim phase, which we were kind of doing earlier in the summer. That's where we evaluate internal controls, update our understandings of your processes and things like that. And when we do those, we look at things like financial reporting and budget, the revenue cycle, billings, revenue recognition, cash receipt, capital asset procurement and recording, the whole expense cycle too, starting with purchasing, accounts payable, cash disbursements, payroll and related liabilities, and that will include your pension and OPEB liabilities as well, general IT controls. And then in phase 3 is what everyone thinks of when they think of audit, which is the validation of account balances. You give us the unadjusted trial balance and support for those numbers. We dig through them and see if there's anything that needs adjustment. And then we're sitting basically in phase 4 right now. So phase 1, detailed planning, that was cut down quite a bit this year, as last year was our first year audit. Last year also had a new GASB statement, GASB number 96, for subscription-based IT arrangements that needed to be implemented last year. This year there were no significant new GASBs, nothing that had an effect on the district's financial reporting that we had to deal with. So phase 1 was trimmed. We didn't have to train the trial balance and create the financial statements and stuff like that. So that stuff was all a lot quicker this year. Phase 2. And so what, last year we documented the first time the district's processes and internal controls over those processes. This year, we just do the, we update, right? And then each year we do, for each of these systems, we will perform a walkthrough basically to verify that, the way that we documented the system is actually happened, is actually what's happening. And then on a rotational basis, we will actually test controls over these significant transaction classes. So last year we did test the controls over revenue recording and cash receipting, as well as payroll. And this year we tested internal controls over the utility billing process and the AP cycle, so procurement, expenditures, and cash disbursement. So with those, we noted no material weaknesses or significant deficiencies, or even just at a lower level control deficiencies, which would be things that we would that we would be required to communicate to the board. So we're going to continue to rotate through these significant transaction classes throughout the term of the audit contract. And so we'll make sure that every year we're going to hit at least a couple of them, and just to kind of to stay on top of that. I mentioned earlier as well that we also do procedures on pension and OPEB as part of the payroll and related liabilities, and so that includes census testing as well. All right, so status and results. So phase 1 complete, phase 2 interim, that was done this summer. Phase 3 is basically done. We have we still go through our QC process and review process just to make sure that everything is buttoned up nicely and properly referenced and all that sort of stuff. So we're so that's as far as the district is concerned. Phase 3 is complete. We're just doing some stuff on the back end. And so we're presently sitting in phase 4. So the draft, the report is in draft. We are waiting for the MD&A and statistical section. I guess that would also include the transmittal letter and stuff to be included. And so once we get those in, we're gonna slide those pieces into the report. Obviously, we're gonna take a look at the MD&A. Do the numbers make sense? We'll give it to our admin team. They'll make a new kind of like a final draft where all the page numbers and table of contents will be laid out, laid out properly, and then we'll basically run that through district review and QC review on our side one more time, and then we'll basically we'll be ready to issue once we will need to continue to stay on top of reading the board minutes and agendas kind of through what's most recently available before we go to issue the report. And then we are also waiting on some responses from our inquiries to the district's attorneys. And I think Wes, you just followed up with them on that, right? So it should be coming here pretty quickly. But that is something that if the attorneys are waiting, that is something that can hold up the draft, because we do have to have the issuance of the financial statements, because we do have to have those responses in, and so we can evaluate them before issuing the financial statements. Let's see. So audit results interim, basically that middle piece there. So no significant deficiencies or material weaknesses in internal control over financial reporting were noted. Again, no opinion on the internal controls. And phase 3, I mentioned earlier that we are going to be issuing an unmodified / clean opinion, and what that means is that the financial statements are fairly presented in all material respects. The significant accounting policies have been consistently applied. Estimates used are reasonable, and the disclosures are properly reflected. And so as far as other results, I am pleased to report that we had no disagreements with management, no material weaknesses or significant deficiencies in internal controls over financial reporting, and no accounting issues were noted. And so with that, that will conclude my presentation. You can turn it
Thanks, Coley. That's a very thorough update presentation. Appreciate it.
Mhm.
Questions from community?
Looking forward to seeing the report, Coley.
Mhm.
So I would like to add that I know we do this every year, and the audit just seems like something that happens every year and comes to you, and it seems like it's not a big deal, but a lot of work goes into this. This is one of our busiest seasons of the year. And Jody and her group, as well as myself, we work a ton of overtime, weekends and everything to get this prepared. It comes out great every year because we put in that time and effort. And the auditors do a lot of work as well. Like I'm sure Coley and his team put in a ton of effort. So while it doesn't seem like much, it really is a lot of effort. We're putting together the act for now. It's just Coley described it. You've got the basic financial statements surrounded by the introductory section, and then you've got the MD&A at the beginning as well as the stat section at the end to make it the actor. The stat section is 10 years of data on, I think it's 15 or 20 different charts and pages of information. So it's a lot to put together. But we're almost done, and everything's looking good. So I just want to say thanks to staff. I'm very proud.
Great. Good news.
Yeah, and I'll say too that the the stats section too. It's Wes mentioned that it's a whole lot of tabs on an Excel sheet, and not only that, but some of them come historically from the financial statements themselves. But as far as some of the rest of the tables, I mean the sources for those tables are kind of come from a bunch of different places, so it can be really a really daunting kind of task annually to track all those pieces of information down. So
Real quick, Coley, is what you're waiting on from BBK just a confirmation of representation? Is that the only?
yeah, we'll see. Yeah, so we it's not just that. It's basically we give them basically a dollar amount, and we say, hey, if you have anything, and this is for basically like contingent liabilities.
Right.
And disclosures in that sense, and we want to know if there's any outstanding exposure, legally, any cases, any claims, anything like that they're working on. Those are really the kind of things that we ask them for. So we basically we throw out a dollar amount, and that's based on our on our materiality that we've set for the audit, and we basically ask them. Hey, if there's any cases where not necessarily on the plaintiff side, but on the defendant side, if there's any cases where the district has some potential exposure out there, or actual, if there has been actual settlements or anything like that. So we evaluate that. We see okay, hey, it looks like you have there might be you either have a liability for this case, or you might have something, and we need to evaluate for two things. One would be for whether or not it needs to be included in the financial statement as a liability at that balance sheet date, or if it's something that, well, we don't know exactly, we're not able to estimate this loss just as of yet or something, but so something that we would potentially need to disclose that, hey, this hasn't happened yet, we don't know the number, we don't have exactly a range of numbers, but just to let the reader know that there is some exposure out there. So typically, I think in your case, they should be able to turn that letter around pretty quickly, because you don't, unlike a lot of my clients that have police departments and general, so they have claims out the all over the place that need to be evaluated and stuff. So in your case, it's more of just a should be just a kind of a formality, and it's something that we do need to to do per auditing standards. And it is something that, as that is typically one of the last pieces of audit audit evidence that we get. So we usually, we can't issue the financial statements or date the financial statements until we have, that last legal letter. But I think for Vallecitos, it's just BBK, right? And just the one. Yeah. So that that shouldn't be logistically too tough to deal with. I have some where we send out 15 to 20 of these things, and tracking them all down late in the game is can be quite a headache. But this one should be no problem.
Got it. Thank you for the thorough explanation.
Okay.
Thank you.
Thanks, Billy.
Thank you.
Right.
All right, we'll move on to item 2, investment update.
I think this one is also, this is gonna be the
Another guest speaker.
finance
Okay.
show, so, yep.
Yeah, so our investment advisors are here today, GPA and Deanne Woodring, I believe, is here to give an update. We try to present to the board on a quarterly basis, whether it be, the status of the economy and how it's affecting our investments, things like that. That's up to the experts. But we do try to give a quarterly update on what's happening there and what's happening with our own portfolio, at least the managed portion of the portfolio. So Deanne is here today to give a presentation on that for the committee.
Great.
Or she left,
Just go and check the participants.
maybe.
She's there. Hold on.
While we talk.
Followed by pounds. Can you hear me? Oh,
Yeah, we got
that was so mysterious. I was in the room, but I wasn't in the room. So
Oh,
how funny.
yeah, it was really weird. So I'm going to, I don't have the ability to share on this, Wes. So
we can do it from here.
Yeah.
if you can do it from there, it's not giving me that ability down the bottom for some reason.
It's
No, that one right there.
Perfect. So it's nice to be in front of you today. So I'm Deanne Woodring, President of Government Portfolio Advisors, and we've been working with you since earlier this year. I wanted to give you a presentation here today that really reflects some of the dramatic changes that we've had in the market and some of the positive impact that we've had and working there with Wes and team on getting the portfolio into a better balanced position going into a pretty big interest rate shift. So if we can go to the next page, please. I always like to kind of start with the big picture, and this is really going back quite a ways, but I use this graph to really represent the interest rates change and that we're up higher and we're down lower, and there's these cycles we go through. The blue line on this graph is representing the short 3-month bill. And this is a reflection of what we have identified in the district's account as the liquidity component of the portfolio. You primarily hold those in 3 short pools, the LAIF, the San Diego, and the camp pools. And those rates will change very dramatically with whatever the Federal Reserve Fed funds rate is. The 2-year note, the green line, is the portfolio structure that we're focused on investing and making outright investments in treasuries, agencies, high-level corporates to balance those portfolios. And the goal when we came on board was you had a lot of liquidity. We didn't see the need for that liquidity. So we've worked with these market changes to start to build that core investment portfolio up, effectively getting your yields up for a longer term horizon of the potential of those rates coming back down, which all the numbers are trending to a lower rate environment in front of us. On the next slide, I talked to why we're looking at that lower rate. So the Federal Funds Reserve rate is that green line there, and that's what the Federal Reserve uses to control the borrowing rates between banks. And their 2 agendas are to fight inflation and to maintain stable employment. The orange line there is inflation, and we've been coming out of COVID where we hit that 9% level. The Fed is really fighting to get that rate down to 2%. We're all impacted by inflation. We're feeling it in our price cost structure, And so recently, just on September 18th, they finally moved those rates down. So we were using a heavier balance into the liquidity and are building that core up. And that blue line there is the 2-year treasury note we're investing in. So the results of us just being patient in this market and working dollars into your core is working out well. And we will continue to add to the investment core as these rates shift. On the next slide, I roll into the kind of the reasoning. So I know when we were looking at your portfolio originally, when we look at just yields and we have distortion in the markets, it's hard to look for the longer term. And that's what we're bringing to the district, is saying there's two components for the portfolio, and that longer 2-year area in anchoring down and taking the opportunity of that spike we had in yields will really benefit you over the next 2 or 3 years. So this is just reflecting that the curve and all the market indicators are indicating that we're going into a lower rate environment, below, well below 4%, probably more in the 3 to 3.5 area. So that's why we're working so hard to get your portfolio to move up in yield and be anchored. So the next slide covers the components of the portfolio. So there's two terms that we use. We look at the liquidity, which are those ongoing cash needs that you have there at the district. So we've mapped out pretty closely what your annual cash needs are. And then we park those in the three alternatives: the LAIF, the state LGIP, the San Diego pool, and the camp pool. Those yields on those three instruments actually vary quite a bit. They were coming into Feb 24, we were yielding about a 540. They've now all broken the 5% yield level. And that's exactly what we're balancing on the investment side, is to continue to invest in the longer term investments as we expected those short-term rates to come down. So the real focus is on how much should be invested in the core investment portfolio. This portfolio is maturing there's maturities in there laddered between 0 and 5 years. And we constantly can pull to liquidity if you need it. So it creates a really healthy portfolio structure for the district, at the same time anchoring down and providing performance over the long run in the portfolio. So the next slide takes a look at what I'm talking about and what that portfolio looks like. So we're preparing and looking at, I call it a holistic approach, where we look at these two parts and kind of do a push and pull on them. The core fund, again, is invested out to a maximum maturity of 5 years. The liquidity identified as a pool, and we're focused on bringing your liquidity balances down and increasing your core account to go into the next interest rate cycle. So the next page reflects where you are at this time. So when we started in February of 24, the core component had about 53 million invested. The book yield, or the earnings yield on that portfolio, was at 292, and the average maturity or duration was 1.5 years. So over the last 6 to 9 months, we've been continually adding into the core portfolio up to 65 million. We've anchored in a book yield now at 363. I'm really hoping to be able to get that anchored up to 4 before the rates turn. And then we extended out the maturity. So those tools are what are going to ensure that the portfolio has more stable earnings in a declining interest rate environment. And then the other key is we've had a mark-to-market change. If you'll notice up on the top, where there's an unrealized loss of 790,000, and that's only a reflection that interest rates were higher than where you bought the securities. And today we're ending the markets on September 30th in a positive territory of up 496. We track that price change. It's exactly where it should be, and we manage that through the duration target of that portfolio. The overall portfolio yield is increased in this environment, and even though rates are coming down, we're able to move it up. So I'm really excited about that, and that's kind of that tactical move. So the overall interest income rate on the portfolio started in Feb 24 at 412, and we're ending about 425. And again, the goal is to really anchor down the yield in that core. So as short-term rates come down, you have a nice balance in the portfolio. The next slide covers how we're doing that and what we're looking at. So we're managing the portfolio to your policy. So when we first started, we reviewed the policy and made sure everything aligned to statute. I will make a note that in the pooled balance down there at the bottom, it says 4%, but your overall pool balances right now are at 39%. So the investment component represents 60%, and then there's about 40% in that short liquidity pool. We're holding U.S. Treasuries, agencies, and some corporate positions. The next part of the compliance report reflects the maturity structure and the constraints that are applied by statute and by policy. So this kind of ties to what Colin was saying on your audit report, but your maximum maturity is 5 years and we're 100% under that. And then also we monitor a weighted average maturity in the portfolio, which runs right around 2.5 years. Then the next slide covers the components and what you currently own. So right now the portfolio has about 22% agencies. So that's Federal Home Loan Bank, Farm Credit, Fannie Mae. We have about 22% in the U.S. Treasury market and 8% in corporates. Our target for you is to balance out at about 10% in the corporate sector on the investment portfolio. And we constantly are looking at a strategic allocation for that. This is kind of a repeat of I just covered up above in your slide where the portfolio investment core is targeted or anchored there at that 364 yield with an overall yield of 424. The next slide covers kind of the graphic of what we're trying to do. We're still the target when Wes and I kind of stepped back and looked at the portfolio. We felt that the liquidity the top part there in the green is your liquidity balances. So we're trying to get that core fund up to represent a greater percentage than the liquidity. What that will do for the district is anchor and hold the yields on that longer portfolio. Historically, longer investments create higher returns. And so we're taking an opportunity of this whole shift we've had in rates to do that. So we've stepped up just slightly around 50% in investments, which is just that little spike there at the end. And then our goal is to get the components to flip from to about 60% investments and 40% liquidity. So next time we see this graph, you should see that blue area up a little bit higher by about 10 million, and that will shift us to target and maintain those core liquidity allocations. So we're looking right now, you're at about 56 million. We're targeting to move up to 80 million on the core investment fund and bring your liquidity balances down to 40 million. That would put you at a 70-30 split. We feel like holding that 30 to 40 million in liquidity is sufficient to meet all the district's cash flow needs. And then the portfolio structure will anchor that yield. And it should provide some ongoing higher yielding performance in the portfolio. And then lastly, I just touch on again, the policy constraints. So this is just a review for you at the finance committee level of where those constraints are by statute. So we can do 100% of the treasuries and agencies, 100% in the bank deposits and 20% in mutual funds, and then 100% in the various pooled portfolios. So this allows for that diversification, and that's how within the investment portfolios, by diversifying not only the types of securities you're buying, but the maturity sectors that you're buying will provide more stable returns over interest rate cycles. And then lastly, kind of our action items. We'll be continuing to work additional funds from those pool balances. We're taking the lower yielding pools first, and you're going to be holding a core component there at the state pool. So we'll work another 10 to 15 million into the portfolio. We're constantly monitoring your cash needs and what's happening. We don't want to be forced to sell securities within this portfolio strategy. We have securities coming due, so if we did need to increase that liquidity for any reason, we'd be able to do that. And then we provide ongoing accountability and reports to a Weston team on a monthly and quarterly basis. So with that, I can kind of stand for any questions that you have.
Hey, thank you for that presentation. Appreciate it. And I have a couple of questions. One, well, first of all, do you think that we're too conservative in our investment strategy?
As far as the components of that, as far as the investment part,
Correct.
you know, the farthest down we'd probably want to go. I mean, you guys have pretty stable cash flows. You have pretty a good understanding of what's happening. So we could reduce that even further down to the 20% mark. The key with how we're managing those investments is, as I mentioned, about 20% of those reside between 0 and 1 year. So if you did need money, we could get them. This is kind of where we struck it on the initial assessment because you were so overweighted the other way when we originally started. So often we'll kind of step into this and get us down to more that 20% level. So if I, knowing your levels are pretty stable, I would say it is conservative in how we're doing it at the level we are right now.
And could you present options to be more aggressive, like you've just described, that fall within the directive?
I could present options to Wes. Is that what you're saying? To come
Correct.
in? Yeah, yes, I can. I can come in with some scenarios. And then it's not so much in the asset class, it's more really the amount that we have in that core. We're not adding a lot in the corporate sector, a lot of yield in the corporate sector. You might see that in the press where yield value and spreads are very, very tight. So I don't feel like there's a need to push and add a lot to credit. I'd more like to see more dollars invested in that core. So yes, I will present some alternatives to Wes.
And Director Brissette, just to clarify, are you talking about not just the strategy between core and liquid, but also within the investment policy of what we're allowed to invest?
It was both, but to Deanne's point, yes, it was just the current setup here is even with it too conservative. And so I like the concept of shifting stuff around within the directive. But to get to your point, am I satisfied that our policy is conservative as well? Not really. I'd like to look into changing that. And to that, Deanne, do other of your government clients similar to us, do they have more aggressive strategies in opening up to, individual securities? As an example, if we put just 5% of our capital towards the Mag 7, in the past 2 years, that could have paid for everyone's water bill. So do you see that in other clients? Is that possible? Is that something we should look at restructuring our own policy for?
Your policy, as far as the asset classes that you can buy, you are at the maximum in statute. So for example, 25% is the maximum that the total portfolio can purchase in corporate bonds. So that's really the only way if we moved higher on those scales. And as I mentioned earlier, it's really about the return components are really driven most by that average maturity. And then you're again also constrained by 5 years by statute. So we're moving towards, it really is moving the dollar amounts up there versus the asset classes. Your policy doesn't need to be changed, in other words. We can go more into some of the credit sectors more heavily than we are. But right now, I wouldn't recommend that because the spreads are tight. But we have that on the radar. So I don't think we can't, your policy is basically at the maximum risk profile that you can do. These 25% numbers are the maximum of the total portfolio. Does that answer the question?
We're muted now.
Oh.
Sorry, we lost
We
you
lost
for a
you.
minute, but we're back, so.
Okay, good. Okay. Did you lose?
Maybe a minute of what you were saying there.
Did you hear me?
We hear you now, but.
Okay, I'm sorry. So the policy limits you have are statute limits. So 5 years is the maximum maturity, the 25% in corporates. So the tactic that we would use would be to increase that core component in this higher rate environment to anchor down longer returns over the next 5 years. And then we could look at going more into those sectors when there is value. Right now, I would not recommend to add corporates just because they're so tight. We go out and buy Apple bonds and they're only at a plus 15. So I don't want to add in that sector right now, but that's an area that that's the way we would add more yield in the portfolio.
Got it. Thank you.
So I will come back to Wes with a recommendation on increasing even more on the core size, and then we'll send a proposal down on getting him there, you guys there.
Yeah, so what that means is moving what we have from camp into, to give it to GPA, and then they'd be investing it based on these restrictions here, which are limited by statute.
Got it. And totally get that. And I know exactly what you're doing of trying to shift towards assuming that interest rates keep going down, which hasn't been the case for the past 2 weeks, where they're going back up again. But I agree with that's where we'd like to be. So falling within our requirements, I would like to have a proposal for how we could be more aggressive with the money that we do have in long term, and also if we add additional towards that long term, or speeding that up, as I think what you're getting at.
So it will basically be looking at moving you to an 80% and keeping 20% in liquidity and going up to 80% on that maximum core amount would be the first step of that. And if we want to go more, I can just talk to Wes and make sure the stability on those liquidity balances are there. And I totally agree with you. I think this opportunity in investing at 4.5% is something that I think we will not have for a long time. I've been in these markets I'm going on 40 years, and I haven't seen rates like this for 15, 20. So I'm excited about them and am aligned with what you want to look at there.
Great. Well, look forward to looking at what you come up with here.
Okay.
So in the end, just so you're aware, I'll be sending you an email about the investment policy. So we'll plan on bringing the investment policy probably to the board in December. So Deanne and her team will look at the statutes and see if anything's changed over the last year. We do that on an annual basis, so it'll be coming to you in December.
Sounds good.
Correct. Perfect.
Thank you.
Thank you.
Okay. Thanks so much.
Thanks, Deanne.
Bye.
Session.
Okay, our last item is calendar year 2025 water rates.
Yeah, so I'll kick this off while Mike gets the presentation going. So as the committee members know, that we have an existing 218 process, and I don't want to cover too much what Mike's going to cover. So this current one is not a new rate structure. We're not proposing new rates. We do understand there's a lot of information out there with what the water authority has done recently. So this is really not a direct reaction to the water authority. This is just a continuation of the existing rates through the 218 that the board has approved back then. And this is, I think, year 3 maybe of that. With that, Mike, if you're ready, I'll hand it over to you.
Yeah.
It's that little-
And normally it's F5.
It's this one right here.
Yeah, normally it's F5. Okay. 1 second. Reorganize. Okay, so as James was mentioning, the Prop 218 that we put out back in 2022, I believe, was a 5-year Prop 218. So any of the rates that are proposed in here are already incorporated into here with the maximum set.
Yeah, and I guess that's a good clarification. The 218 set the maximum rate pass through that we can do. And then the board every year basically reacts based on the actual rates that's been being seen, with the 218 setting the maximum.
Right, and then I'll get into it a little bit more, but the part of the maximum set was the 6.5% at the time, which retrospectively was probably not a good idea. But at the time, things were 4.5%, 5%.
Mhm.
So who would have known? It's kind of like setting CPI maximum at 3% a couple of years ago, and inflation went to 8. So I'm going to briefly go over the terms that we use. COSS, cost of service study. Seneca County Water Authority is abbreviated SDCWA. We talk about SFR, single family residence. Our typical residence is an average single family residence. It's a residence with a 5/8 inch meter using 13 units of water per month. We use RTS, it's the ready to serve, it's basically the fixed portion charge of the bill. And the IAC on here is infrastructure access charge, it's a charge by the San Diego County Water Authority. A brief synopsis of the calendar. We started this process back in 2021 where we met with Raftellus to set up the new rate study. And it was finally approved in board in September of 2022. And again, that was a 5-year process. So it's set up for 23, 24, 25, 26, 27, I believe. And then every year, as James mentioned, we have to come back to the board to basically certify or approve the new rates. And again, the maximums are set in the Prop 218. And here we are today on the 30th to review the preliminary rates. We're going to come back to the board in 3 weeks for hopefully approval for the rates.
And typically the rates are effective to January of that year, so the following year.
So real quick, cost of service study, what it does is basically starts with the financial planning, basically your budget document. So it shows what you want to do is make sure you're still in alignment with adequate cash reserves, your debt service coverage ratio, and all that develops and determines what your revenue requirement is. And with the cost of service study, you need to make sure that you equitably allocate those costs to your particular customers. And it's the foundation for being in compliance with Prop 218. As I mentioned, we did a 5-year structure, so we're not changing the structure of any of the rates. And I'd say index, it's not a true index, but it's indexed with the board annually approving it. And the index is really whatever the rates are passed through from the water authority, with the caveat, the maximum cap is 6.5%. So again, alignment of the rates with the revenue collected. You want to make sure there's no subsidies between classes. And it's an allocation between your fixed charges and your variable charges. The one thing we'll see in a second is the water authority is reallocating their allocations and they're putting more charges on the fixed. So we'll see that, and it's an alarming number when we get to it in a minute. What that would mean for us is eventually when we go out for new Prop 218, we'd probably want to put more on the fixed. The problem with that, the issue, and the delicate art of that is the more you put on fixed, the more it hurts the low users. Those that use 3-4 units a month because their fixed charge is higher. Here's the alarming issue. This year, San Diego County Water Authority, I know you guys have heard the 14%. Our all-in cost is 12.2. There's a couple of reasons for that. I'll explain that in a second. The fixed component went up 30%.
That's the increase, that's the delta.
That's the increase from our fixed charges from the water authority.
It went to what?
But what's the, I don't know what the total percentage.
Total dollars or percentage?
That's the delta.
No, that's, if it was $1 last year, it's $1.30. Last year, our fixed charges were like 5.7 million, now they're 7.3-ish million.
Yeah,
So they went up.
For us, the fixed charge went up 30%.
Yeah.
So.
Part of it is because I was saying they reallocated, and I think I have a slide on there, they reallocated some of the transportation charges from variable to fixed. The commodity portion went up 8.7. And really that's, again, because they moved a portion of the commodity to fixed. And it overall is 12.2. The reason it's 12.2 is this is probably the first year that desal helped us in a sense, where desal went up probably about 5%. So when you factor in the 14% from the water authority, the 5% from for desal, it comes to a combined composite 12.2. And a lot of the numbers you hear when you hear it from the water authority, 14, it's kind of like how I'll say our average single family residence. Well, not everyone uses 13 units of water. When they say 14%, it's an average of the 22 remaining agencies. One agency might be 15, another one might be 12.8. So it's just an average. So again, our composite is about 12.2. And as we mentioned, as per board action back in 2022, our limit that we can pass on to the consumer is 6.5%.
So, you know, we're gonna get pretty close on the commodity side, but we see with the 30% increase on the fixed side, we're gonna be really far off on the fixed costs. Or revenue.
Yeah, right now I have it in the next slide. It's about $3 per customer per month.
Were we considering doing SDG
As a pass through?
Yeah, well, we have with the new, I'm sorry, There's a new way the board action that took on the electrical costs, the normal electrical costs for pump stations per our policy. It'll be part of the pass-through process approved in the budget every year.
And the majority of the overall electrical costs are pump zone costs. So the portion that's probably allocated to the rest of the customers is fairly small. But we could do something like that as well when we do our next tweaking. So the fixed charges, oh, I'm sorry, and then the internal VWD portion is going to increase by about 4%. The purchased waters, if you remember, is about 75% of our budget, 73% of our budget. So obviously 73% of 12.2% is uncontrollable.
And Mike, the 4% is everything else you're saying?
Yeah, that's basically everything else.
Which includes SUG.
Yeah,
Does that also include salaries?
that includes salaries.
So even with salary, which is a big chunk of it, we've only gone up 4% year over year. So
And we maxed that too in the Prop 218. We've maxed it. We put the max can only be 4%. So I just wanted to show you, I have a bigger slide of this, so don't worry about straining your eyes. This is the actual numbers from the Water Authority. So I kind of wanted to delve into this a little bit deeper. Normally we don't go into this much detail, but I wanted to kind of show you. So here's where I was telling you about the transportation charge. The bottom part is a fixed portion. Last year that was 0. This year, and these aren't VWD numbers. These are total Water Authority numbers of 30 million. That's what's allocated to the 22 agencies. So you'll see, let me go and bring the next slide. Oh, we don't have untreated PSAR water, so I'm just kind of eliminating that, so you don't have to worry about that. The supply rate, which is just the cost of water, is going up 13% from 1,200 to 1,355 per acre foot. The treatment rate is going up 25%. And that also affects our OMWD contract because they treat our water and we get a 20% discount of it. But our OMWD treatment is going to go up 25%. Our transportation, it looks like it's going down, but really if I convert this $30 million from a fixed to a variable charge and kind of pro forma it and pretend that it's still in the variable charge, it actually went up 24%. Our customer service charge, almost 20%, the storage charge, almost 16%, supply reliability, about 18%.
But our infrastructure access charge on 4.6, so that's good.
Yeah, that's such a small portion of it.
I know. It is.
What's the history of that IEC? Why is it separate?
Because they wanted to charge per meter equivalent, I should say,
Yeah.
per customer. And a lot of agencies back even before pass-throughs were the thing, they passed through that. That was just a charge for the meter. So I don't really know the extreme history of that, but I know it was just to access per meter or meter equivalent in this case. Also, the other thing that's making these fixed charges go up is that last year we had 24 agencies to divide this all about. Now we have 22. And if you remember, I think I used the analogy of one of your roommates moving out when we did the pump zones. So now you have the rent divided by less people. Same cost, less tenants.
It's actually
Right.
higher cost. And
Right,
less tenants.
higher cost. Yeah, the landlord raised the rates and you lost a roommate. So double whammy. So what does this mean to our customers? Well, here on the top left is our proposed commodity rates for 2025. So we have a pass-through rate of 536 from the Water Authority. Our VWD internal cost for our tier 1 customers is only 12 cents per unit. But actually, we're selling it for negative 65 cents. Because if you remember, we took a chunk of the property tax money, it's discretionary revenue, and are offsetting the tier 1 water.
Yeah, and that's been adopted in the 218 process, and that's kind of the way we kind of balance the books to try and ease the pain for our customers. So that still continues for the 218.
Right. So we say there's no subsidy. You can't subsidize a certain class. You can't say, okay, we want to give commercial buildings free water or something like that. But we can use some discretionary revenue and equitably allocate it to a certain cost. So in this case, everyone uses tier 1 water. When you use your first unit of water, it's tier 1. So we are using the property tax revenues to offset the cost of tier 1.
How is that sustainable year to year?
It depends on the property tax revenues that we get. We have property tax and we have RDA. The RDA is at some point supposed to sunset.
It
Yes.
sunsets in 20 to 30 years, so I'm not sure what the actual.
So you have plenty of time.
So I'll be gone.
Not from now.
No,
Yes, it's 20, 30 years from when it
It's
started.
rolling, it's 2030 is when it started, but however, the state, and there's always that risk of the state could take both the property tax revenue and they have the ability and the power to. And
Same way they can take our reserve fund.
so, exactly, so with that, when we, for example, when we go out for loans, we look at our, you know, our basically our mods, you know, we look at it and Wes's team looks at it as if we didn't have that, do we still meet our covenants? Yeah.
The coverage. I guess my question is that shouldn't it have gone up significantly? I mean, property taxes have gone up. There's been a ton of people that bought new houses that are now paying, you know,
So we
30
don't,
grand a year. in
we don't get
tax.
property tax from that, that traditionally, we're not the
Right.
city or the county. Our property taxes that we get are set from redevelopment districts, and redevelopment districts are all gone, so that's been set in stone. So when the RDAs were considered, and that's been gone since the recession. So all the property tax increases, for the most part, that we've seen since 2008, you know, we're not getting it, we're not the county, we're not the state, we don't actually get any of those.
So it's pretty stable right now, and it's only when the RDA eventually dissolves.
It is
will it go
increasing,
down.
'cause we also.
Yeah, it is increasing.
We also get a portion of the 1% property tax based on the parcels that are in our district, and it has been increasing, not at a dramatic rate, but it has been increasing year over year.
We got a percentage of the 2%.
Very small percentage. So those are the new proposed rates with, and are basically against our current rates. And I'll show you what that means to the average customer a little bit, so you don't have to take out your abacus or your calculators right now.
Keep it in my melon.
So the ready to serve charges, the fixed charges portion, projected at $41.72. It's currently about $40. So what does that mean to our average single family residents, right? So our current rates are $104. But again, average single family residents, 13 units of water using 5 each meter. Always have to caveat that is about $105. Of that, $24 of it is the BWD portion of it, and $80 is the water authority portion. Now that's actually a misstatement, because that is $80 based on we can only raise it 6.5%. It's really, and I have it somewhere in my notes, it's really about $89, maybe $90. So we are subsidizing the water authority's increases out of our reserve fund.
So what you're saying is that 80 should be 89.
It should be 86, 87.
Well,
I have it somewhere.
You'll have
but-
the numbers, I've seen your presentation.
Oh,
It comes
okay.
through later.
So with the proposed rates, the average bill will go up to about $111. An increase of $6.80 a month, or 6.5%. $1.50 of that is basically from BWD.
So, yeah, I guess that's a good point. Our cost for what we control is gonna raise people's average water bill by about $1.50.
$18.
That's an important point to keep in mind. With our customers.
And then the rest of it is a capped pass through that doesn't truly reflect what the full cost is.
And the next bullet will show the critical, and I wanted to use the sky is falling, and it kind of is the sky is falling, and I told Wes I was going to throw this joke in there. Kind of is the sky is falling for a couple of reasons. One, we had a whole bunch of rain a couple of years ago. That rain that fell from the sky depressed our sales, depressed water authority sales, and
Metropolitan.
yeah, and everything else that's depressing sales is really hurting these costs. So what would have happened if there wasn't a cap on the 218, the 6.5%? Well, if I was setting rates today and I had no cap and I was looking at our revenue requirement, the average single family residence bill would be $118, projected to be $118, as opposed to the current proposed 111. So it's really from last year's 103 to the 118, it's a $13.36 increase, or 12.8%.
So basically double.
So we
Yeah,
needed
right here.
12.8%, and we're looking at capping at 6.5%.
Yeah.
based on our project.
So you can phrase it that we're saving the customer $6.56. I'm going to phrase it that we're under collecting $6.56
Spending
per
some of their
customer.
reserves.
Right, it's coming out of reserves.
Well-
One day, if those reserves aren't there, you're gonna have to bump the rates up $6.56 plus whatever the water authority puts on.
And this includes the utilization of unrestricted funds to artificially lower the rates on top of that, which is basically almost all of it, like 90-something% of our unrestricted funds are used towards rate, I'll call it reduction. mitigation.
So the customers are saving $6.56 per month at the detriment of the district and our future operations.
Well, let's go on.
So what that means now is that 656 basically equates to about $3 million coming out of our reserves. And just to show you the compounding effect of what this means, because last year the net increase was around 9%. We only passed through 6.5%, so it's compounding. So last year, the coming out of reserves because of the limits on the 6.5% was only about $1 million, $900,000. So this is the reserve sheet that you see in the budget presentation all the time. So I just stole this directly out of our budget. This is what it currently looks like. This now also has in it built-in increases of what is needed in order to achieve us going right to the floor and hovering around that floor. So the Water Authority was projecting a 40% increase over 3 years. So we had to build that into our rates as well. So we maxed out our rates in order to at least come to the floor, so we don't be in violation of our debt service coverage ratio, our days in cash, or our floor. So this is the currently approved budget, as I said, and right now, this fiscal year, we're budgeting a $4.6 million operating loss
So
in our
that's
budget.
important too, because we should be budgeting for zero, right? We want to be net zero, or we need to budget so we can fund replacement of existing infrastructure, right? Because we have our infrastructure, but our water customers need to continue to function. We need to replace it as it ages and as it expires, and we have the asset management plan. So we need to budget to replace those assets. We are budgeting a loss of $4.6 million this year, and we have losses going forward. We've built in rate increases projected to help us recover that and actually come back to zero by 2027.
And
now the rating agencies have looked at our plan, and that's why we were giving the AAA rating again this year with a stable outlook, because we have a solid plan for recovery of those losses. If we continue to have those losses, it's not sustainable. And, it just
The Water Authority was in the same position.
we don't want to be where they are. And that's the other thing.
They weren't the same, they weren't a lot
They were a
worse,
lot
they were
worse,
right
but-
on the edge of getting
Yeah.
downgraded.
And the biggest problem that I had with the Water Authority, and I had it on the chart that was handed out like last week to you guys, but I can show it again, is that they, under pressure, used too much of the rate stabilization fund. They
Right.
overutilized the rate
They
stabilization fund
zeroed it out.
They zeroed it out
3 years.
quickly.
Yeah.
Rate stabilization fund should be a long-term,
Right.
not you go to zero and then, because then you have to
Well,
build it up eventually.
During the worst possible time.
Yes.
Yeah, they didn't do rate increases when they should have done them, or didn't do sufficient rate increases, and that's why they ended up in the position that they're.
Well,
in.
it's kind of a lesson if, because at the end of the day, if you under collect from revenue starts compared to your cost, sooner or later that bill comes due and there's a huge adjustment. And that's where the Water Authority sits now, where because they artificially under collected for several years, now that's why we're looking at a 40% increase. That's one of the reasons of that environmental. There's a lot of reasons.
So what I did is I did a scenario that if we did not pass through the 6.5% increase, what would these numbers be? And the next one, total sky is falling, is if we didn't pass through any increases over the next 5 years. I know it's completely unreasonable. I just wanted to show the compounding effect, because a lot of people, and even when I explain it sometimes, I don't think I do justice to the compounding effect of what this really means. And I think it's important for the board to know this.
So one more note, Mike,
Yes.
before we go on. The floor and the ceiling are also shown here, and it's important to remember that those are based on adopted and approved board policy for the district, right? So we have to stay within policy. Another very important thing that the rating agencies look at is that we have sufficient reserves to operate over our 5-year plan, and that we're within policy limits. So those are huge things for us, right? And the third thing that I wanted to mention is another very crucial criteria for rating agencies in order for us to maintain our credit rating is the willingness of the board to approve rate increases when necessary. So that's what this slide is, created to show, and that's very important.
And just to add to that, because what's reminding me, so when you look at the floor, if we were to start over and adjust that floor to today's reality, that floor number would be significantly higher. Because that floor number is based on a historical cost based on the developer building on bare land. And then, okay, we obviously escalate that number based on inflation, but now you're digging in the streets with people and traffic. So the costs are significantly more for replacement of an asset than the original install of the asset. So what happens is, and this is all standard practice for most agencies or all agencies, those costs are put in based on the original developer cost, which is usually non-prevailing wage on a bare piece of land to put in that infrastructure. So it ends up costing half as much or even less than half as much as the replacement cost. So those numbers would double if you took a honest look at that floor. So last thing I want to do is move those numbers because it'll make our financials look really bad.
And unfortunately, what we're seeing with the asset management plan is that he's exactly correct. A lot of the replacement costs of our existing infrastructure is a lot higher than what's shown.
Not just asset, just our CIP costs.
What's their single biggest cash flow need? Is it capital project?
Yes, because it's $30 million or so. So
Yeah.
I'd say, besides water purchases. obviously.
Water purchases are single biggest, and then
Yeah.
our single biggest that we have more control over is capital. Because we can't stop people from using water. If they want to use 20 units of water, we can't say you've done at 10. I guess you could, but that'd be a whole different direction. But the problem with that is most of our capital needs, basically, if you stop spending capital, you also have to put more moratorium on any development growth. It would stop development growth and capital. We'd end up basically being litigation with the city and development entities. So.
So yes, correct me if I'm wrong, but a lot of our major projects coming up are growth projects and they have a component of replacement as
Yep.
well. And if we don't have rates to fund that replacement component, then we wouldn't be able to do the growth component. So it stops that and it just.
That's a good point. That's why I said it would end up basically stopping all the work.
Couple of questions. Prop 4, if that passes, we don't get a dime from that $10 billion.
That's at that water.
Yeah, it's a
bond?
water bond.
A water
Yeah,
bond?
we as an agency probably wouldn't get a dime from that.
Well, it's called a water bond, but there's a whole lot of other
Other
stuff.
things in there.
Yeah, I think because of that money, that there's if you look at what's allocated for water, it's a very small percentage.
It's like water.
Yeah, it's about one.
That's true.
And then how it's allocated for water, it's going to get swallowed up by like 4 or 5 big projects, and that's why
It's called a water bond because they historically get passed easier than other labeled.
Sorry to hear that. For anyone listening at home, please consider that in your voting.
I've gotten a lot of calls from personal friends about that bond, and I've given them my personal opinion
It
on
does
it.
say Parks, Environment, Energy and Water Bond, so it's probably mostly going to Parks, Environment and Energy.
I could almost guarantee.
And then your steep drop from 24 to 25 is for the big infrastructure project.
Right, there's the net CIP, after accounting for like interest income is about 8.3 million of that. 4.6 million is operating loss, and about 8.2 million, 8.x million is net CIP.
4.6 this year or 4.6 combined?
This year, and I have a slide that'll show that.
Okay, and then coming back to our investment conversation before this, it doesn't seem like we could move to a more aggressive liquidity because that is funds that are imminently needed, right?
Yeah, and our investment advisors don't know this picture. So I understand what she's saying, but at the end of the day, there's probably going to be a happy medium between where we're landing at 40% and
Yeah,
it's not going to
okay,
land at
yeah.
20%.
Checks are gonna be needed to be.
Yeah.
But
But she's aware, like I had
But she's
discussions with Deanna about how much we can actually, she wants more because she gets paid for more, so
Right.
that's, she's gonna encourage that all the way.
Yeah.
But she's also working on some liquidity, and I explained to her that we'd have to keep 6 months of operations and reserves as well as potential, funding of CIP, so we can't give her all of our liquid funds.
Like, so just to clarify, so this is from the budget.
This is from the budget.
And then the budget has the budget assumptions, which include the 6.5% pass through per our existing 218.
For January
And
2025.
then just keeping up in the future with the water authority rate increases, which is at 40% over 3 years.
Right, which also means though, recapturing that 6.5 to $6.56 that
On the back
we're
end.
already in the hole.
But to clarify, the water increase isn't 40% over 3 years.
It is.
Our assumptions aren't that high.
Close, but not that high.
They're close.
Very close.
30%.
Probably 30%
Yeah.
over 3 years.
Because it's just, obviously, the water authority passes the 14%, that's the average. Your mileage changed it.
Or
because
it's
of-
12,
Yeah.
12.2 is our,
Yeah.
all in. Like I said, I never thought I'd see the day where desal helped us.
I don't think those lines are crossing, so don't get excited.
Again, the next two slides are just to show you what would happen. They're not.
So the what if scenario.
Yeah, so the what if,
These
so-
are good to see.
So here's, and I'm gonna flick back and forth just real quick because it's the same slide, but just basically it takes away that 6.5% for January 2025. So you'll see for the next year, it's not that big of a deal. It's only $1 million from 32 to 31. We'll look right here. Partly because it's only 6 months, right? It's January 2025. That doesn't really go into effect until really February because it's a month lag. So it's 5 months out of the year. The real impact would be the following years. You see that 27 then goes to 20, it's probably 24 because it's right on that. We go from 27 to 21, and I'll only do the last year.
Yeah, so.
We go from 30 to 19, so it's $11 million.
Stop there, so that still assumes that after that, we still catch up.
We
Yes,
still have the rate increases assumed originally, so those are still, this is just without the 6.5% this year. And you can see that in 2026 going to 27, we're in clear violation of our own policy.
and we're probably in violation of our days in cash, probably not our debt service coverage ratio until we get into the outer years. And then the next one is just the sky is definitely falling, right? If we did no rate increases for the next 5 years, I just throw it out there just to show, specifically, I just want to show the compounding effect of what that means. Is that it just plummets to negative $21 million. So we go from a positive 45 to 21, that's a $66 million.
I don't get how that math doesn't work.
It absolutely works.
How is that?
Because
Right today, you're collecting how much?
45, $50 million.
And your
40.
gap was not that big to where you're reducing 14 million.
So
13 million.
we're going from 30 down to 21. That's $51 million over the 5 years if we do no rate increases.
Well, that's assuming that the water authority goes through with their 40%.
So we're assuming their rate increases and we don't do.
Right.
Yeah, not based
And
on.
they're going to do theirs, and I'm gonna deal about that.
I'm not sure, like, why do you think, this has been an unusual few years. Obviously, there was the shock here this year, but everyone is returning to normalcy.
Not the water authority.
Yeah, there,
There's
So
a
there's
deep
no-
hole.
Yeah, they're in a hole really, and they, at the MAM meeting, there's another, the water authority and also Metropolitan never budgeted for any of the, basically peripheral canal project, which is a $10 billion project. So that's another 8% that is not on the books for the water authority, so not shown here. That's gonna hit 26, 27. So they're looking at now going from 40 to 45, 46, 48, 50% over a 4-year period into the 3-year period to try and kind of smooth that out.
so we've had like 20, sorry to interrupt you. We've had like 22 meetings over the last over a year, and nothing in any of those meetings has hinted at recovery or been positive about rates not increasing.
Now, the good news is if there is really dry winters, basically a drought type situation, water use goes up, it will smoothen that out. And every year, the water authority will reevaluate what they're doing, so that 40% could turn to 25, 28, 30%. And that is definitely a possibility, but nothing that we're doing today or even in the future 218 is setting a commitment for the board or to our customers that we're going to pass through 30-40%, because if we don't realize it, we're not gonna charge our customers.
40% doesn't make any sense at all. You could buy desal water for cheaper than that. So why wouldn't you go 100% desal at that?
Well,
Well,
you-
you'd save an extra 13%.
You'd have to build more desal, right?
No,
So,
Well, I mean, assuming
yeah,
we could up our contract, but we,
Yeah.
you know.
well, desal's still twice as expensive
Yeah,
at this point, so
pushing 4,000.
40%.
If it goes up 40%, it's closing that gap for you.
Yeah, it's closing.
It's definitely closing the gap, but it doesn't close the gap. We have to go up 100% to equal desal.
So one of the
So,
reasons why we got into these, in case it ever does get there.
yeah, well, it's supposed to
Why the
cost, but
liability.
the desal went up, desal went up quicker.
Yeah.
But it is true that the desal rates up here are regular, basically potable water rates up here, and it's
It's
gonna close that
closing.
gap.
It's closing, but it's
It's not gonna catch it.
not why I'm still working here.
No, it's-
I mean,
They're
you're-
both going up.
Your average citizen in the year 2027, 2028 is not going to be able to afford their water bill, let alone people that can't today. So it's, I mean, this sounds like to me,
Well,
sorry, County Water Authority, but this is a state problem at this point. I need to supplement you because this is,
it's crazy.
it's untenable.
Yeah, it's crazy, and Director Eltrop's been part of the meetings, and he's seen what's kind of behind the scenes, and the Water Authority they're behind the eight ball. It's, you know, I could point fingers, it's a lot of people who aren't there now, but they need to be solvent. Because if you don't have the Water Authority, we don't have water. So, and if you have some other entity comes in, the costs aren't gonna get any cheaper, it's gonna get as expensive or more, so. There's definitely moves that the Water Authority is doing to mitigate this, but those moves really won't even be realized for, 5 years with the contract.
And just to kind of piggyback on what James said, if that 30, 40%, 45% over 3 years doesn't materialize, we won't pass through those costs. We're only gonna pass through what we need. So if for some reason they find a miracle, we're not gonna pass that through.
Well, I mean, my hope is drier winters, more normalization of flows, but the problem is when you're already down, you've spent all your reserve, your replenishment funds are gone, you have to reload at some point. The Water Authority is, what's their debt now? I'm trying to remember.
It's
Billion.
2
$2 billion?
2 billion.
Yeah, they're $2 billion in debt, they're taking short-term loans to make coverage, and they have another $500 million in debt that they still need to allocate.
Yeah, and
So,
if you look at it, Metropolitan,
Actually, that number's
worse situation.
and Metropolitan's
They're
in a worse
borrowing
position.
money to operate, basically.
So it
Yeah.
is, but for Vallecitos, I mean, this is a bad example because this makes an assumption.
I just
of-
wanted to
It's
show
extreme.
compounding.
It's extreme.
This is just to show compounding, not
Yeah.
any reality.
There's no
It's
reality.
just to
there.
show compounding, and I'll go with that with the next slide. What I did here is just kind of show what our controllable costs are versus non, and you can label whatever you want as controllable. So what I did is I started with our original budget of 54 million this year, took out water and electricity, because really we don't have control over those. Very minimal over electricity, which we've done with the solar and some other things, but not that much. So I came up with a subtotal. Then I took out any regulatory or legal requirements, because we have to do those. We can't not be in compliance. So that just brings us down to 13.3. Then I backed out labor to come up just to show that all this stuff minus labor is about $2.5 million of our total $54 million budget. And actually that number is actually pretty much holding steady. So that's what you have to play with.
So you end up with our material and services cost, which is our controllable cost, but even that to an extent, you have to have things.
Supply, you have to have the bleach and the whatever else Ed uses.
Well, yeah.
And even
Chemicals.
It's kind of in there.
Yeah, it's all in there.
Well, put that in perspective, the Water Authority's controllable cost is 7%.
Yeah.
Of the total.
Yeah,
It's even less.
it's even less.
And then to get back on the reality of those numbers, so here's what we were talking about, the replacements to reserves. And what Wes was saying is you want to find where you're pretty much even a little bit over, because this is what funds your capital replacement. So right now we're at about 4.6 this year budgeted, next year's 1.6 in the hole.
And that's because there's an assumption in the budget that we have normal pass-through, and we're basically going to be swallowing Water Authority rate increases for about 6 months. And it's the first 6 months, which is a lower water use, because obviously July, August, September is higher water use. So it's not 6 months, doesn't get divided in half exactly.
Yeah.
Well, but we're already behind the eight ball because we did the same thing last year, right? So the Water Authority raised rates on us last year, we were limited to like 6%, 6.2%, and their rates went up more than that. So
And I was going to show you guys just to kind of pat myself on the back, but I do a lot of stuff by hand, by the way, because what I was telling Wes and James is I don't like when people just do PowerPoints, because that's just numbers. Where'd you get that number? Did you just hit a button? I do all my work.
you can make different color pens.
I do all my work by hand a lot because I need to know what it is up here, right? I can't just tell you it's a 14 point or 12.2 and not tell you what it's made up of. So I was actually going to hand these to you guys to show you, but I actually made a slide of it. So just.
Good, go and put it back on
Oh,
presentation.
sorry.
Um,
Oops. Yeah, I
So thanks to what the investment advisor just told us, right? Wasn't that the equivalent of the extra interest that we made this year that we just repurposed and,
So we were able to get a little over, I think it's about $2 million in extra interest this year by putting most of our money in camp. So you got about 2 million.
Right. But
we're still operating, at a $4.6 million loss. And what you do is you see the interest go into the reserves to fund replacement. So obviously with a $4.6 million loss, we don't have any funds to fund replacement of infrastructure. So it goes directly into reserves to do that. It keeps us, it helps obviously, but it's not filling the gap completely.
So again, illustrative purposes only. This guy's not really falling. This is if we didn't pass through the just 6.5% increase this year, but pass through all the other increases that are scheduled in the budget. And you can see what the cumulative effect is. And this is, by the way, this is additive. This isn't, oh, we're 2.7 million in the hole. I got it down here. Here, these 5 years is 5.7 million coming out of reserves total. If we didn't pass through a January 2025 6.5%, but still pass through all the other ones, it goes from 5.7 million to 17.3 million. And again, just for grins.
And I couldn't believe that either. I actually had to check the numbers while we did that to make sure it's 5 million to 17 million.
Yeah, just for not passing through 1 year because it's 6.5 1 year, then it's that plus the next year, plus that, plus the third year.
That makes the assumption you're not making up, you're not going to do like a 20% increase. to make that work.
Correct.
I got it now.
Correct. And then just for giggles, if there was no increases in the next 5 years, and this is where that number went to -21. And that's actually, yeah, it's 57.2 million additive over the 5 years. Again, just for illustrative to show
That's
compounding.
It's kind of a fallacy of rate stabilization funds, is that you think you pay it once and you've solved the problem going forward,
Right.
but you have to
And that's
carry
why
that through.
in the past, I've always argued for setting the rate what it is and either giving a refund or doing a limited term 10 cents per unit of water for 6 months, because it's a finite amount. You know what that amount is. If you artificially and keep rates down 10 cents, even if it's just 10 cents per unit, after that year, you got to build up that 10 cents plus the
Well,
next rate increase.
Well, that's one of the nice things on how we're using our unrestricted funds is we get a small percentage of the increase in property tax revenue. So it helps offset that rate, but it's not keeping up because that small percentage doesn't keep up with the percentage of the rate
The
increase.
growth, yeah.
So there's still a gap. We're still offsetting it. If you look year to year, our offset amount is 77 cents. Before it was 74 cents or whatever it was several years ago. It's gone up. It's gone up, but it's not keeping up with the rate increase because those percentages are higher. So it is, to your point, it is helping. Those property tax increases are helping, but the wholesale water rate increases are outpacing us, or outpacing that.
So our next increase proposed is in the approved 218.
Yes.
Yeah, so
what's the next one after January?
So the plan is, I put it in my kind of my monthly updates to the board a few times. So we have a multi-pronged approach that the finance team is working on. We're going to actually eliminate, potentially, this is all pending board approval, $40 off our customers' bills by moving the sewer off. So that would represent a 36%, almost 37%. 35%, call it 35 for easy math, percent decrease in the bill. However, then over the next 3 years, we're going to add 40% back. So from an average bill, especially for our most vulnerable customers, they're going to see their water bill actually go down and come back up.
Water
to about,
sewer bill.
Water
go
sewer
down.
bill go down and they actually come back
Yeah,
up.
we gotta be really careful with it.
Yeah, but the property owners will end up getting about $450, $470 back on the property bill, tax bill.
But in a way, it helps because it's only paid twice a year versus every month. So
Yeah.
Also, if salt comes back in the picture, that will help. That's tax deductible. Right.
Yep.
Yeah, wouldn't that be nice?
Yep, that would be.
I think both sides are honestly talking about bringing it back.
I hope so. Personally, I hope so.
10,000 limit.
So-
I really hope so.
So with that, and if that does happen, that's actually tax deductible. So it has a several problems. Psychologically, on a monthly basis, the water bill will appear to go down and come back to about the same level as it was before, roughly. Based on projections, we don't know what really might happen. It may be lower if the water sales are great. It may be worse if things keep on going the way they're going now. But you know, I'm optimistic. I actually think water sales will rebound. And we won't see a 40%, but we'll probably still see a 30% increase from the water authority, unfortunately. We're gonna do the
Over
other one.
3 years.
Yeah, over the 3-year period. So with that, you'll actually see a net even in water bills roughly over the next 3-4 year period from a water sewer bill perspective.
So do you propose redoing the 2018?
Yeah, so I don't trust the water authority's numbers, and not to say that it's their staff's fault or anything. I don't trust that the crystal ball is clear enough with everything going on between environment and supply. So what I'm planning on doing is starting a new 218 process. So we're planning on actually, yeah, so just to back up, I guess chronologically, we're going to do a new 218 process next calendar year. The board, finance committee will see it in the spring with the hope that we bring it in conjunction with the budget. And then it gets adopted where we catch up to existing rates in July. So July 1st, in theory, this is all up to board approval. You have a rate that now has full pass-through with the water authority. But by August, so for your December bills, so by August, basically, we'll have about 1 month where there's a gap. We take the sewer off the tax roll. So there may be a month where we're not collecting that sewer, and we haven't put it onto the tax roll yet. We have to work out that
I
timing.
mean, the tax roll was calendar year ago, so I think
Yeah.
that will start in January of 2026.
So, okay, so there'll be that, and then we'll have normal pass-throughs like we have now, a higher percentage that the board considers annually to keep up with the water authority rate. The idea is we keep up with the water authority rate, and by January 2026, people's water bills are actually lower from the water bill standpoint, but not necessarily when you add in the tax. And we want to be very careful about the messaging on that. So we want to work through committee and board on how to measure. We're not going to lie to people. We're not going to try and hide it from them.
Yeah, I don't want it to
Yeah.
appear to be a show meeting.
Exactly. So we're going to be very upfront about it and just be honest about it. But it will definitely psychologically it'll be better from a most vulnerable residents will be better, and actually even from a property owner standpoint, if that does get repealed and you don't have that $10,000 cap, it will actually be better. So it's for bad situations, the best wins what the staff can come up with. So
Yeah.
it's probably pulling all of our levers basically.
And hope for drought, which makes this a strange business.
Yes.
Yeah, so we don't want it to rain. Real quick, we were in a MAR meeting, is that what it's called?
Yeah.
This morning. Marv, whatever meeting with the water authority this morning. And it's funny because Helix, the guy from Helix was mentioning, he was, all of us are all in the same boat. A lot of us now have pass-throughs. A lot of us have multi-year Prop 218. And he was saying we're hurting because we're limited to 15% pass-through. And I'm laughing on my side. Like, holy crap, if you only knew, which I actually then shared with the group. Ours is 6.5.
Yeah, sure.
So because of their 30% on the fixed, he's hurting.
Yeah, eliminating is 9.5.
Yeah.
They're hurting. So almost every agency is going to be doing new 218s. They've either started or most of them are starting in 2025.
And I was showing Wes earlier this morning, I think it's Uema, sorry, Uema. That actually is a good segue to my next chart. So we do the rate surveys, right? And I'm hating the rate surveys now, and I don't want to do them for you guys the same way anymore. The reason is what I've been saying for the last 4 or 5 years. With the pass-throughs, when I go to look at people's rates on their website, they're very ambiguous on what their costs are. They say, and pass through from the water authority, and they leave it blank. Now we include what the pass-through is. So what I have to do when I do my rate survey, which you'll see I took off all the names, is I have to estimate what their pass-through costs are based on history and based on the percentage increase that the water authority says. Well, the water authority says 14%, so
But
It's
it's not,
I
but
think
it's
they
not
put out,
14
they
for
put
everybody.
out, the water authority puts out a list
Per-
that shows by.
but even
agency.
that, it's not,
Even that's not.
it's not because it's combined fixed
No.
variable. They'll give their variable, but they won't give their fixed. But they'll say whatever the pass-through is. So they throw up their hands and say whatever it is. A lot of them put some of it on their tax roll. A lot of them are still using the MWD refund as an offset. There's a couple other things. So the reason why I'm taking the names off is because some of these are estimates, and I would hate for City of X to say our bill isn't $109, it's $106.42. But what this does, it gives a reasonable estimate of what the conglomerate with the overall increases are. And I think it's more important to look at what the total average is versus any one individual average.
And I think Mike's being a little too, basically, Mike's taking the lower number of his estimates. So his numbers are probably the cheapest that water bill probably is. It's probably in reality more expensive, and when we do a little bit of spot checking with counterparts, his numbers are lower than their actual bills are.
So I will tell you that the lowest, it's Lakeside. It doesn't, I gave it away. But to compare us to Lakeside, we don't have the same business processes we do. We don't have any local
Everybody's
water.
different.
So to say that we're gonna be better than Lakeside or equal with Lakeside, we can't compete. They have free water.
No.
No. They have free water. Get me free water.
Give me a drill that's long enough and I will give you free water.
Well, Ed was
It's not
mentioning,
free.
Ed was mentioning though, that we probably don't want to because of the landed areas and the chicken.
Oh, no, our water is.
Yeah, the
High nutrient.
that's a different story, but whatever. So I think it's more important, and I think the message that I want to bring to the board and to management is where we stand holistically with all these agencies. So with that in mind, I will point out ours. There's the $111. I will point out the lowest, the bookends, and the highest. And more importantly is the average and where we stand.
And not to give it away, just the highest is still one of those agencies that moved to MWD, so moved out of the.
Rhymes with Albrook and Ainbo.
Walbrook.
And those are the two.
And those are
highest.
the two highest. Okay. So average increase for this year, and again, to reiterate what James says, a lot of the agencies haven't put their 2025 rates out there. So this is actually being generous. The average water bill is probably about 134, but I can only do, as an analyst, I can't make up a number for an agency. I can only do what's out there.
Well, and correct me if I'm wrong, Mike, but some of those agencies actually have proposed rate increases that just haven't gone through yet that are higher than the 7%, or the 7%.
Right. And if I knew of them, I might have included them. There's one agency that has an increase in July of 25. I did not include because it's too far away. 11.2, 11.9%. And that's not in here.
Let's talk about this for a minute. $7 approximately
Yes, ours.
times 20,000 customers.
23,000.
So over 150 grand a month is what you're looking for. That's what you need.
Well, we need more than that.
It's not as simple as that because this is our average single family resident. When you talk about a 2-inch meter, a 3-inch meter, they're using not 13 units of water. So
Oh, that's the average you put up there. So
it's an
why
average-
Can I use
oh.
that for the?
because this is an average single family resident using 13 units.
It's really average
For the most-
It's our residential.
of 20,000.
Yeah, or 20,000 customers.
All right, that's around that. You want 200 grand a month? Is that what we can talk about? Would that be fair?
But we need more than that, because we need 12.2% based on the water authority's rate, increase, right? So.
Well, this is as far as we can get for now.
With our tax.
I'm just walking through a hypothetical scenario here. So let's say you need 200 grand and there's lots of different ways to get 200 grand and you illustrated
And it's not really 200 grand. It's really,
a month.
it's for next year when we go out, it's 2.3, yeah, about that for the first year. But then it grows to almost 3 million.
Yeah, well, we gotta take it year by year, right? But so that's what you gotta do. You gotta work backward from that number and how do you get there? And you want to pass through all of that to customers because that's what we've done historically. And you said, these are our fixed costs and this is what we have to tinker with, but nobody said anything about tinkering with that stuff. I mean, I haven't hurt anyone to say, let's walk around and see if we can save 6% on pens or ink.
Well, again, you
do that
have
every
this,
year.
this line number to really work with.
Great detail.
And that's what comes with the budget when you get the 30 pages of
So we
materials and
we
supplies.
line item it by like hundreds of dollars.
Actually, in this year, we did a completely different process where we really cut the budget. So our budget variances are a lot tighter this year than they've been before, and our spending percentages for capital and stuff have hit the mark at a much higher level. Like we've hit 80% of that.
this year in capital.
Yeah.
And again, I put it in perspective that 200,000 a year, let's call it 2.5 million a year. I mean, 200,000 a month, let's call it 2.5 million a year. That's really what our remaining budget is.
So
you'd have to collect- Cut everything,
That's chemicals, everything. So
outside services,
Batteries,
pens.
office supplies, which aren't that, we can do without paper.
Yeah.
But we need computers. And the
There are in the budget.
I need paper.
You could, I'll tell you what, though, you could have cut that in half. There is stuff that can be done. I mean, if you're IBM and you're told you're going to have a 25% deficit and you need to figure out ways to get there, you get there. You don't.
But with an IBM, they can cut out their least productive sales line.
And they've got
They
profit.
they can cheapen their products.
So if you look at SCG, it's probably if you look at SCG, it's a better example. So SCG, they look at their rate structures and they do actually the same way we do, except they have profit in it. Because at the end of the day, we're not making widgets, so you can't compare our business model with a manufacturing business model because we could sell less product and save. There's fixed costs, but you save a lot of variable costs by buying less material, buying less things, and selling less products. Reducing staff, selling less products. But with us, when there's no way, and maybe there is a way, but there's no way that I would see us saying, okay, you can only use 8 units a month of water. Okay, and if I could do that and restrict every meter to water, then I could say, I'm only gonna buy this much, I'm gonna buy this many chemicals, I'm gonna reduce costs here, reduce costs here, and as a district, we can reduce costs all the way around. But if you as a customer want to use 22 units of water in a month, because it's a hot month and you have stuff going on, you have to do it. So the infrastructure, the fixed costs, the pumping, the electricity, the chemicals, the ability, the staffing, the support is all there to deliver water to you or any customer at 22 units a month or 2 units a month. It's the same basically infrastructure that does that.
I totally get it. I just don't think the public likes carrying all of the water instead of sharing it. So it's a hard sell to,
And one of the things we've done this year in our budget is
But look at the electricity side. People haven't batted an eye at these ridiculous rate increases over the past
And the
5 years.
bonuses these guys get.
Why? Well, one reason is because they're governed by the PUC in San Francisco. There isn't a local office to go down and bitch
It's a
about
complete
rates.
shadow world.
But I mean, look at our pump sunrise. We didn't have a single letter. We didn't have a single customer. It was, the staff did an excellent job messaging the reasons. And I think, I don't disagree. Raising rates is never a good feeling. The staff does not want to raise rates. But I think with proper messaging and understanding of what makes up your rate and how it's passed through, and the fact that our controllable costs in the grand scheme of things are really 24% or 26%, 26% of the total cost. And what we're trying to do is we're balancing the rest, and we're actually offsetting it with increased revenue, with other non-restricted funds. So at the end of the day, if you strip those away, our increases would be significantly higher.
In the last 10 years, we're going at a 3.7, 3.8% increase in our operating costs that we can control.
Yeah.
On average.
That's the base
I
rate. of
totally get it,
inflation.
but if you're going out and asking for 6.5%, you should really say, we've took 3% and we'll ship, or 3.25, and you'll do 3.25, and that would be the appropriate way to.
Really, it's don't look at it at 6.5%. It's
12
point something percent. So we are doing that. We're taking half of that and eating it.
We're
out.
eating, we're
But
eating.
we're eating it, and we're eating it permanently. And seriously, if not doing any increases, we're going to be bankrupt by fiscal year 2028. I have it down here. I even have the word bankrupt.
I mean, that's
We will be bankrupt if we don't do what's reasonably needed to do.
I mean, that's a good point. We're not looking, just like when we did the pump stone rates and Director Boyd Hodgins had under the impression we're trying to make up for lost revenue there. We're not going back in this scenario, we're not going back and trying to recoup the 4.6 or recoup the 1.2. That money's gone. That money's been gone. It's coming from everything that we do, including it's coming from our ratepayers, it's coming from us, it's coming from every operational costs. It's been gone, and that's because there's that divide. We're locked at 6.5, and that's what it comes down to.
And we also ate $2.5 million last year, so you're talking about $7 million we've already lost as a result of being capped on our rate increases. Not to mention, we come forward with budget originally, it's a lot different than what we end up with, right? So we brought you materials and services, very detailed, 30 pages. We went through that, we reduced it, right? So we reduced as much as we possibly could because we saw this coming. We knew the water authority was having issues, we're gonna be raising our rates. We've also kept our staffing levels. I mean, we've gone down from 115 positions down to 110 over the last, 5 to 10 years. So we've reduced staffing, we've reduced costs. It's just, we do as much as we possibly can.
From a board perspective, we have a compelling story. We have the most expensive wholesale water costs because of their desal in the county. We have no local water source of any quality. We are
fourth lowest.
And if you look at our operations, we're basically tied for the lowest amount of staff per connection, which is one of the things we showed during the budget. And we're also one of the only growth agencies where we've kept this low rate as we've increased 3,000 more connections over that last 10 years. So from a board and public perception standpoint, even though not everybody's going to want to hear it, we have a good story. We have a compelling story of showing, based on the industry, that we are doing more with less.
Yeah, we're ranked 4th overall. We're 13.7% below the average, and even with a rate increase, we're still, ours is only 6.5, and the average is 7%.
And I kind of get in disagreements with, again, showing this. I don't care that we're 4th. I want to care for 20th. What we really should be doing is competing against ourselves. Are we the most efficient that we can be? Like I said, we can't compete against Lakeside. And if I want to say, okay, compare me to Albrook or Eanbo, right? That's not a good comparison either. Let me get to the next slide real quick. Sorry.
Riz, I'm gonna get a call from Albrook.
Albrook and Eanbo. It could be anything. So really, I want to show, this is what you've already saw. So the previous average from the last survey was 120, gone up to 129 to 7.02% holistically. BWD 104 to 111, 6.5. In previously, we were 13% below the average, and now we're still basically 13, actually a little better, 13.74%.
Even with the rate.
Even with the rate increase. And then several agencies that I put on here, I haven't listed their 2025 rates yet. So even this 25 number, this 129 is on the low end.
It's conservative.
Then what I did also, just to show you, if we put through the whole pass-through, if we weren't limited by Prop 218 and 6.5%, if you were asking me, Mike, you're the principal financial analyst, what should rates be for the average single family residence? I will come back to you today and tell you it should be $118.05. Even with that, we would still be 8.66% below average. Now, right now, again, we're only looking at the 6.5. So we're looking at, that number.
So, and then what the board will see now is obviously at November 20th, we're going to bring this forward for board consideration. Hopefully what plans can we support, and then come February, March, a new 218 process. We will have a better crystal ball. We know the 14%'s in, which is 12.2. We know water authority is working on the 27 rates. The METS rates, which are projected to be higher than expected, we're gonna have information on that. So then we'll probably just set a 2-year. I just, unless I get different direction from the board, I don't have any confidence that the crystal ball for the water authority and MET could be more accurate, in 2 years. So with the changes going on.
Yeah, I would say doing 5 years out is just it's way too cloudy. I mean, we end up redoing it.
So
every
the
time.
good thing about 5 years, sorry to interrupt, the good thing about 5 years is that we can always change it.
Right.
And it's not necessarily, we're not locked into it, it's actually a cap. So if we do our 5 years, we're saying, okay, what's the most we think it's going to be in 5 years? Hopefully, if that turns out correctly, we'll be able to stay below the caps, because those are just the max.
That's what we thought the last.
Yeah.
Yeah, but the problem is that nowadays, if you were asked staff to put a cap, we're gonna put 20-something%. And if you project that out for 5 years, the numbers are
There's
huge.
a public relations problem with that
Yes.
too, because people assume, well, you're just gonna do
Yeah.
that.
And really, I want to acknowledge Director Garcette, what you said though. Right now, when I set the rates, I'm setting them based on what is already approved in the budget. I can only do with what I know. I'm an analyst. I do with what I know. If you, and I don't mean you, if you can cut 500,000 from the budget, whatever, I'm gonna put that in my rates. And the rates are not gonna be what I'm saying today. They're gonna take into account those cuts or that extra revenue. So even though we say there's a max of 20% or wherever that is, I am looking at truly what is our budgetary needs based on what is already approved. So I don't want to sound like I'm argumentative.
No, and it's good to be argumentative, actually, but I guess my point is, there's all different sorts of factors, and many of them outside of our control. The past few years have been exceptional and extraordinary in many different ways, and it's not going to be the ordinary moving forward. Beyond that, we've got, what, 1,000 new customers coming on next year? So that's new revenue. You've got higher property taxes. You have the Hillside project that could bring in an extra $1 million a year. You have a dozen other properties that could be developed with a car wash or something that, could easily be done relatively quickly. And I just don't believe the concept that your water bill can actually only goes up. Because it can go down.
I will,
in my point of view.
if those things happen and James says, here's an extra $5 million in property, that, it's gotta be not just one-time revenue, by the way. Because one-time revenue would only offset one-time
Of
costs.
course, we want.
But if there was a stream of revenue or a stream of decreases in expenses, I guarantee you, I would set rates accordingly, and if rates went down,
Yep.
I would absolutely bring in lower rates.
And beyond that, contracts and stuff of this nature, like desal. When we talk about desal, and you'd have to go up 100%, but who's to say we can't get creative with that and say, hey, we'd like to make a $10 million purchase of water right up front from you, or something along those lines, and structure it to where it would be 50% less than.
Let's go back to the time where you show the.
It's all about being creative.
Right there. So you're absolutely right. And so the district's always done this, but this year the management team and staff has done even a great job. You're going to see that 4.6 million is based on budget, correct? So, okay, the actual number is going to come in less, much less.
And hopefully if all that stuff you talked about happens, it goes even less.
Yeah, so it's gonna come, and as it comes in less, it's gonna be reflected in the next budget. So I'm hoping, I don't know if I'll read it, but my goal, management team's goal is, can we cut that number close to half throughout the year, find incremental savings throughout the year, cut that number down over a little bit. So, and that's what we've been doing. Staff has been activating. We don't report it to the board because each one's a, hey, $20,000 savings, $5,000 savings, $500 savings. But every supervisor, and that's kind of in my sheet that I provided to the board members, it was closed session stuff, but the management discussion on the budget that I provided, that's been actively going on. We have savings in desal that Mike's realized that is not reflecting that number. There's savings in staffing, there's savings in benefits, there's savings in insurance moves that's been done, all those things. And at some point at the end of the year, we're gonna report back and say, and I never stated out that to the board to cut that number in half because I didn't know if it was possible. But and it's not going to be in half, I can tell you that. So, but that was kind of my internal goal. And I don't think these guys that's the first time these guys have heard it. So cut that number in half. Jody, do it. No, but I think we're going to have a significant savings of well over $1 million, $1.5 million at the end of the year. That's my guesstimate right now, based on what I've seen from our financials.
And that's great. And that's the sort of PR stuff that we need.
And then
Yeah,
that's what
we
we'll
just need to
show.
demonstrate that we're
Yes.
doing everything we can do.
Everything.
So, on top of cutting that budget down and basically showing that we could be swallowing up to 4.6 million, staff has been actively doing exactly what you've asked. And you and I have talked in one-on-one meetings, and that number is going to get cut down.
Yep.
Okay.
I mean, there is no bill too small to be renegotiated.
So And so we're actively, now it's doing better, sure, I'm sure there's still room for improvement. This is the first year that we've really taken this type of approach. We've always taken this approach with more aggressively. So every year that being cut down. One of the things still that works against us on that is when we set the budget this year, we set a tighter budget than I think we ever have in general. At least we put more scrutiny on that budget. So that's why some of the numbers when I talk to us, yeah, it's been even tighter. We've cut out things that I would call niceties. So with that, you're going to see those differences. You're going to see that concerted effort. And then that will reflect in our future revenue increases. Because some of those changes are one-time changes, some of them are permanent changes. The DSAL savings this year is a one-time. Yeah.
But
So-
we're hoping usage goes up, we're hoping all that stuff happens, and as that happens, we might get closer to where the water authority is at 12.2% of what we needed to eliminate that 4.6. And going forward in the future budgets, next year's budget, we've got some pretty, I don't like the rate increases we have in the budget. I wish I didn't have to put them in there. I think Mike feels the same way. So hopefully going forward, if all that stuff happens, those will get lower. Because I don't want to bring forward, if we had to come forward with a 19.5% rate increase, can you imagine how that is for us and how it looked, how you guys would feel about that? Hopefully with all the, that good stuff you mentioned, if that all happens, that 19.5 goes to something more palatable.
But let me say something right here. If the number is 19.5, I'm gonna bring 19.5
Yep.
because I'm an analyst.
should.
That's what I do.
That's right.
So I'm not combative. I want to make sure
No,
that you guys know
Wow.
I'm bringing through, and it just kind of show you guys. I know they can't see it online, but I have detailed. No, I can't do it. I have detailed from the water authority. Sorry, I thought this was touchscreen. Every single charge that we mentioned about the customer service charge. This and I do multiplications of what the costs are. So I know what our costs are for next year. So I'm fairly confident of that 118 number of what it should be for next year
And-
with the numbers I got from the water authority, which are set.
And then the real thing with all this work and effort, and it's good work effort, it's worthwhile work effort. We have one big mathematical thing that works against us. 74% of our costs are coming from the water authority, so we can't balance that on 24%. When we take out some of our fixed costs, our SEG costs and everything else, now we're really balancing on less than 20%. So 20% of, so basically at that point, 74% of the cost coming from the water authority increase. There's only so much to balance on the 20% that's remaining that's controllable. And then the only other option is really cut down services to nothing. And that is basically a nuclear option because it will increase costs over time.
Mike saying he knows what the rate should be this year. I mean, he can say that with confidence because he looks at our budget actual history, right? So our budget actual history you've seen has been less than 5%, usually around 3%, sometimes 1.8%. Mike's had years where he's been within $100,000 of purchase water estimates. So we do a pretty excellent job, mostly Mike probably, in doing those estimates. So I think he can say with confidence that that's what.
Should just like after I know we've done this before, and Director Oliver, you asked this before. Here's that 12.16% increase. I'm sorry, people on the screen can't see it. And this number is just taking 74% of our purchases are purchase water. So just purchase water costs would mean a 9% increase to our customers. That's holding every other cost, that other
We had
13
no
million.
internal.
And that means salaries,
Salaries.
no colas, no raises, no
Right.
promotions, no nothing. That's 9% with everything else being zero.
And that includes benefit increases, so
Right.
as benefits increase, we don't even pay that.
Right.
So. So, yeah, we are doing everything that you've asked, and maybe I've done a bad job, relaying that to you, because it's a complicated thing, and I also don't wanna provide a number that isn't real. I'm hoping to give you good news later when I know it's realized, so.
Yeah, and I don't think you have necessarily done a bad job of conveying that to me. I'm just challenging you to do even more.
Yeah, I get it. And I think we can, and I think we're looking at savings, but right now we're starting at a negative. So all those savings are just trying to get us to zero.
Right.
At this point, at some point, if we're at zero, those savings could actually get us into the positive, which would be actually a reduction in rate revenue need. So right now, we gotta get out of the zero before we can even start getting out of that.
And reduction rate revenue need, I just want to explain that even more, means not as big of an increase. It doesn't mean a decrease.
Yeah.
So let me go ahead and continue, and then we can chat more if we needed to. So the timing and recommendations, so the Prop 218 allows for rate adjustments every January 1st. James already mentioned that. So to implement the pass-through rates for 2025 on January 21st, 2025 for bills mailed out after January 31st. So they really wouldn't be due until almost March 1st. So any increases. I think that's it.
And there's been a lot of questions, and this is definitely something that is a big item. Just to clarify, this is not a new rate. This is a pass-through of the existing 218 process, which the board considers for policy.
The one thing I did want to show, this is my personal bill from City of San Diego. So if you look, in red is what my bill would be if I was a Vallecitos customer. My bill, and they do bi-monthly bill. My bill, and I'll say it out loud, was I used 12 units of water a month, so 24 units in the 2-month period. I have a family of 4. My bill was $378. If I was a Vallecitos customer, my bill would be $278.
Wow.
And now that's divided by 2,
So
$139. And I'm paying $100 more every 2 months, $50 more a month. So believe me, I see rate pressures.
So
And I'm a ratepayer too.
at our water academy, it was shared that some of the customers that used to live in another agency to the north of us, their rate of serve charge is $150.
Can use
Okay.
no water, yeah.
And it's worth noting that I'm the Vallecitos Water District customer, and I tend to be quite frugal if you don't know me very well. So I also don't want the rates to go up.
Don't have to laugh. It's not necessary.
Why do they do it by themselves?
I don't know.
It's a billing savings. They have to generate half the amount of bills. It's just an administrative.
And they only have to read, because they actually they lift my lid, and my house is only 8-9 years old. I'm surprised they don't have the AMI or whatever. They lift my lid and read it.
Yeah, that's why also.
Well, it's still got their billing, their system's still screwed up.
Yeah,
And-
it's
and-
still
People are
good.
still getting
Oh,
it,
yeah.
still.
And I think they have a large rate increase passed through. It's 9% or 11%.
Yeah, they just did a 4.6 in July. So what they're doing is a January, July. So it makes it seem like smaller increases, but every 6 months. So yeah, they just did a 4.6 and they're doing not 8-9% in July.
They just winning the Golden Fleece Award for their metering problem.
I wouldn't doubt it. I don't
I
know.
think they do.
So, but
You too can win that award with the right application of money.
yeah, exactly.
No, I mean, the bad
Oh,
award.
No,
That's a bad one.
that's a bad one, like the orchids and onions.
Well, then it was one. Based on what we've seen here.
I think unless the committee has any questions, the staff is
No, it's-
available.
Great discussion, I appreciate it.
Put on my gravestone, water bills can go down.
Absolutely.
Totally agree with you.
So next steps, we're looking at November 20th for the.
Yeah, so November 20th, we'll come back to the full board. It'll be almost the same presentation. I'm actually gonna cut out some of the stuff. I'm not gonna show around my personal water bill and things like that. It'll be a little bit more.
You should.
Streamlined. I'd have to
It could be
redact
okay.
I'll redact my stuff, but yes, I would.
You moved to San Marcos. New
I
development.
used to live in San Marcos, right by our old AGM.
KB Homes, Lennar, did some nice work.
I live right by Hollandia Dairy.
All right, well, I guess we're adjourned.
Yeah.
Thank you.
Thank you.
Thank you.